The US and China are locked in a fierce contest for global supremacy. Neither side wants to come to blows, but both know that economic heft and technological prowess are key to winning this global race. And both are prepared to take more assertive actions to advance their own interest, even at the expense of established international norms.
Hello, everyone, and welcome to the Week Ahead on Nomura Podcasts. It's Friday, the 28th of February. My name is Euban Paracuelas, Chief Southeast Asia Economist at Nomura in Singapore. I'm recording this in Jakarta, where I'm traveling at the moment. Here in Indonesia, sentiment seems to be quite subdued, which I imagine would be the case for other large EMs as well, not just small open economies as we heard there from Singapore's Prime Minister Lawrence Wong, really reflecting the ripple effects we are now seeing from global policy uncertainty and trade tensions. In that context, I think in the week ahead, China would be of even greater focus as the National People's Congress convenes on Wednesday and fiscal measures could be announced. My colleague Jing Wang in Hong Kong will outline our expectations and whether he sees the MPC to potentially provide a lift in market sentiment. We also just recently upgraded our China GDP growth forecast for this year. But we begin with the US, and Jeremy Schwartz previews the February employment report and provides his thoughts on the latest announcements on tariffs. And then in Europe, Andrei Stepaniak from our economics team in London joins me to discuss our expectations of the ECB. I also ask him where he thinks we go from here after the German elections and what's Europe's next move around the peace deal. So let's dive in. All right, let's start with, America first. And I'm joined by Jeremy Schwartz from our U.S. economics team in New York. Hey, Jeremy, welcome back to the podcast.
Hey, Euban, great to be back.
Cool. So first up, I guess the February employment report is the most important data point next week. What do you expect from there and any potential implications in Fed policy from there?
Sure. So again, we expect another somewhat messy report. We're forecasting that job gains picked up modestly in February, but really that's just due to some temporary payback after we think weakness in January was driven by unseasonably cold weather, LA area wildfires, and potentially some overly punitive seasonal adjustments. So top line, we think, is going to improve, but under the surface, there's a lot of things to be nervous about. Employment surveys from businesses have been moving lower. We saw the labor differential and the consumer confidence data move down, and we're beginning to see some signs of upward pressure on initial jobless claims, and in particular, not in this February report, but as we get into March and beyond, we might start to begin to see some impact of both the federal hiring freeze as well as some of the layoffs from the Department of Government Efficiency, DOGE. So again, we think that you can see some improvement this month, but it's sort of a last hurrah, and things should be on a slowing trend through the start of the year. In terms of the unemployment rate, we think that can stay stable at 4%, and we still think that wage growth should be solid in the 30 to 40 basis point range. So not any disastrous news on the labor market front, but we do think that some moderation is likely the trend once you get past this February reading.
Great. Yeah, interesting point you bring up there on the impact of DOGE. Any other data releases that you're watching closely this week or the week ahead?
Yeah, so the other main thing on the calendar next week is going to be the ISM business surveys. And here we expect, again, similar to the payrolls report, some decent readings, but probably more signs of forward-looking weakness. Something we flagged actually just out in a note earlier this week was that regional manufacturing surveys have held up reasonably well, but if you look at the forward-looking components in them, they're starting to move lower. And it seems like the post-election boost in sentiment from businesses expecting kind of pro-growth policies from the Trump administration is beginning to fade as people are facing the reality of potential tariffs and somewhat unorthodox fiscal policy with potential unilateral cuts from the executive branch. So a lot of uncertainty makes it very difficult to plan and invest. We're beginning to see that hit some of the survey data. That said, cyclical sectors were recovering and we're already on an uptrend. We think that carries on for a little while longer, so we're not expecting anything to dip below 50 this month. But again, more signs of cracks emerging.
Right. Okay. And as we speak, finally, Jeremy, we've been just getting some headlines from Trump on the tariffs. I guess in Mexico and Canada, they're now going ahead on the 4th of March, which is the end of the 1-month delay period. But then there's the additional 10% on China, which seems to be new. So what do you make of all of that?
Yeah, so it's almost hard to keep track of the various headlines coming out of the Trump administration and the shifting in deadlines. I should say we're recording this on Thursday. On Wednesday, we heard from Trump and from Commerce Secretary Lutnick that the Canada and Mexico tariffs would be delayed until April. Now on Thursday, we're hearing that they're going to go ahead as planned in March, along with additional tariff increases on China. By the time the listeners are hearing this podcast, we might have a different set of headlines entirely. So again, we're not really focusing too much on any particular pronouncement because we've seen that Trump really wavers back and forth on the specifics. But our takeaway continues to be that tariffs are very likely to ramp up. We think that April deadline for the various reports from the Commerce Secretary and USTR is going to be an important threshold and potentially a time when you see more broad-based and more systematic tariff increases. Again, there's a bit of a distinction between Trump, who tends to speak in kind of broad principles. It's always round numbers, whereas you see much more strategy and maybe more of a longer term plan from some of his advisors on the economic front. So again, we think we'll get a little bit more clarity going into April. That doesn't rule out that you get some increases in March. And we've seen there's already been some increase against China. But again, following any specific headline is likely to be misleading at this stage.
All right. Yeah, fair enough. Yeah, let's leave it there. And thank you so much again, Jeremy.
Yeah, thank you.
Okay, I have my colleague with me, Andre, on Europe. Obviously, a lot of things happening there at the moment. Andre, thanks for coming to the program.
Hey, thanks for having me. Great to be here.
Cool. So I guess let's start with what's ahead next week. I guess the main event would be the ECB. What do you expect in terms of the policy rate and any forward guidance and the tone from there?
In terms of the policy rate, it's pretty much, I think, baked in that they're going to cut the depo rate by 25 basis points. Everyone really is expecting that. It's also a forecast meeting. We should expect some minor revisions to the near-term growth outlook and inflation outlook. On the latter, it's largely owing to the recent rise in natural gas prices we've seen. They've actually risen a fair bit during H2 2024, and this will obviously feed into the ECB's inflation forecasts. I think the most interesting thing, though, is the guidance. A lot of ECB speak of late has been questioning how restrictive is the depo rate, how restrictive are rates in Europe at the moment. And recall that in January, the ECB still maintained wording to the effect that rates were restrictive. Now with people questioning whether or not rates will be restrictive at 2.5%, we do think the ECB will alter the wording, that we don't think there's enough of a consensus to say they're no longer restrictive. We think more likely that the ECB will say that rates are now less restrictive than previously, and also the ECB must monitor or assess the level of restrictiveness going forward. So a much more nuanced take on how restrictive rates are from that perspective.
Great, interesting. And can you just remind us how many more rate cuts do you expect from the ECB from here?
So in our expectation, we think that they're going to cut rates until 175 by September. So aside from the March meeting, we're forecasting 25 basis point rate cuts also in April and in June. We think they'll skip July and a final cut in September. We do see downside risks, largely owing to Trump's tariffs and the risk, obviously, that hits growth much more materially than we penciled in.
Okay, got it. And then in terms of data releases, are there anything else that you're watching and worth flagging?
I mean, the main bit of data really is the euro area aggregate inflation figures for February. So these are the flash February figures. We're forecasting a tick down in the headline HICP print. So we're thinking 2.3% after 2.5 previously. In terms of core inflation, we think that'll also tick down marginally 10 basis points. And that's largely owing to underlying momentum in services inflation, which the ECB is heavily focused on slowing. So we're forecasting a sort of 10 basis point decline in the annual rate of services inflation.
Right, excellent. Now, on the hot topic of the day, I guess, is the German elections, which just finished. So I guess the question is, where do we go from here, and particularly in your thoughts on the fiscal outlook and defense spending?
In many respects, the result of the German election was the best one we could have hoped for, in the sense that the CDU came first, as was widely expected. They will only need to have one coalition partner, not two, so that makes forming a government much easier. So we're expecting the CDU-CSU to partner up with the SPD, so no sort of contention there. Also, it's worth bearing in mind, neither the FDP nor the BSW, so those two minor parties against fiscal loosening, neither qualified to enter into parliament, which makes the CDU's job much easier of getting some sort of fiscal loosening ahead of the line. I think here, though, it's worth caveating, we have to differentiate between defense spending and public investment. So in the new parliament, the Linke got quite a few number of seats, and they're very much in favor of loosening fiscal in line with the CDU-CSU, in line with the SPD, in line with the Greens, but for public investment only. The Linke are very much against defense spending. So in terms of the public investment side of things, we're expecting about 0.3 to 0.5 percentage points of GDP. However, Merz already, he's actually hit the ground running, despite technically not even being chancellor. The parliament reconvenes in 30 days, or 30 days from the election, so that's less than 4 weeks away now. And so effectively speaking, Merz is working with the current parliament to get a 200 billion euro special defense fund over the line. That's equivalent to 4.5% of GDP, so that's very sizable and quite significant. In reality, though, it's not that Merz is necessarily the most fiscal or the most defense hawkish person out there. It's more the fact that his back's against the wall. Trump is effectively indifferent, as he said, to Europe's fate. And Merz was very clear in a very statesman-like setting when he said after winning the election, Europe has to be independent from the US. And so Merz is fully aware that he has to essentially do more for Germany in terms of fiscal on defense to rebuild its military capabilities, as essentially they are going to be the front lines.
Yeah, really interesting. And on that related topic, I guess we have this peace deal on Russia and Ukraine, which is being negotiated by Trump. Any update on where we are on Europe's potential next move on this?
No, sure. Look, I think Europe feels very sidelined, actually. So Trump hasn't involved Europe in the discussions whatsoever. Trump hasn't even involved Ukraine in the discussions. He said that Ukraine does not need to be at the table. Shocking, but that's what he said. And so in terms of Europe's response, at the European level now, we're talking about, again, massively increasing defense spending. So we're thinking about Euro bonds, for example, Euro bonds allocated to defense spending. We're thinking about reallocating unspent NGEU funding towards defense. We're also thinking about carving out defense spending from the EU fiscal rules and also carving it out from the excessive deficit procedure measures, such that countries like France and Italy, who are under EDP, can actually increase their own national issuance for defense spending as well. This whole idea being that Trump is clearly a catalyst for transatlantic tensions more than anything else. However, in terms of the deal, so we had headlines very recently that Zelensky has now agreed with the US to I suppose, quote unquote, sell or to give Ukraine rare earth metals, so their natural resources, to the US, on the condition that the US provides some sort of long-term security program for it. So I think that's the sort of thing we're monitoring at the moment. it feels like the peace deal actually isn't far away and that we could be there sooner than we think. The question is, to what extent is this a good deal for Ukraine, and sort of who wins out of this deal? We still don't know, for example, whether the negotiation will result in Ukraine having to give up eastern Ukraine, Crimea, etc., to Russia, or whether or not Ukraine will be able to keep onto that territory. That's still a big question. Also, we still need to see the details of what will the US actually get from those minerals and what's the actual long-term security plan the US is now tentatively committing to. So still lots of questions, I think. But so far, everyone seems to sort of be playing ball. I think the issue as well for Zelensky is he knows that if he doesn't agree to the US deal and the US walks away, the US is going to pull all of that funding, pull all of that military support, and Europe doesn't. Although Europe's now committed to increasing its defense spending, we don't yet have the resources. It'll take time to actually build up our resources in terms of tanks, troops, ammunition, etc. And it's time that Ukraine doesn't have.
Okay. Sounds like still some uncertainty, even if we could get a peace deal sometime soon. Thanks, Andre. Let's leave it there.
Thanks, Ewan. That's great.
For Asia, it's a big week in China, so I'm very delighted Jing Wang from our China economics team can join me today. Jing, thanks for coming back to the podcast.
Hi, Ewan. Thank you. Yeah, great to be back.
Okay, first of all, on the data front, we have the trade numbers out from China. Anything you expect from the release? And importantly, I'm interested in your views whether we are expecting some signs of front-loading ahead of the tariff implementation.
We expect this January-February exports data to remain resilient. Likely print a middle single-digit growth, despite this 10% U.S. tariff, which became effective on February 4th. As you mentioned, front-loading could be a key factor. Exporters might rush to deliver the goods to the U.S. In anticipation of much larger tariffs ahead, including this potential withdrawal of small parcel tariff exemptions and this potential additional large fees charged on ships coming from China to the U.S.
Okay, interesting. And these will be for both the months of January and February, right?
That's right, yeah.
Okay, great. And then I guess the big event for next week would be the NPC on Wednesday, so all eyes on that. What do you expect from there? And I guess importantly, can the package of fiscal measures potentially surprise markets on the upside, given some of these expectations being adjusted in recent months?
Yeah, so the government is expected to announce a wide range of policy targets at this annual NPC meeting. We expect the growth targets to remain unchanged at around 5%. Inflation target, which has been always set around 3% over the past decade, could be lowered to around 2% to better reflect the realities. On the fiscal package, the official fiscal deficit ratio as a percent of GDP could be raised to 4% this year from 3% last year. And the implied annual quota for the central government general bond could be boosted notably to facilitate more transfer to local governments and to ease those local fiscal pressures. On special bond, we expect the quota for central government to raise to 1.3 trillion from 1 trillion last year, and the quota for local governments to be raised to 4.4 trillion from 4 trillion last year. And on top of those, Beijing may also announce 500 billion special central government bond to recapitalize the state banks. Overall, you see more spending and more bond quota this year compared to last year, but the scale of the overall fiscal package could be smaller than many market participants initially thought, as you mentioned, right? But market expectations have already become more realistic in recent weeks, partly because of the stock market rally and the pressure or urgency for Beijing to do a big patch of fiscal stimulus has clearly reduced. So we expect a limited surprise on the announcement of those fiscal numbers. And we have been stressing for a while that how to spend those money is more relevant than just the number or scale of the package. And just one thing to flag, we may have a press conference next Thursday, just one day after all those policy targets were released. And PBOC governor and the finance minister might attend a press conference, and more details could be provided on the policy implementation. So this warrants more attention.
Great. Okay, thanks for flagging that. That seems important as well. Okay, and finally, Jing, in your latest report, you raised your 2025 GDP growth forecast for China to 4.5 from 4%. Can you explain why, and in the context of external risks seemingly on the rise and potential trade tensions? So, what's the reason? What's driving that upgrade?
Oh, yes. So we have a lot of things ongoing in China, right? You mentioned you have the external risk, but at the same time, some encouraging is also happening within China. But somewhat similar to what happened to China in the past couple of years, the Chinese economy is off to a relatively good start. We have this shocking success of DeepSeek, and it has triggered a stock market rally, which may boost investment and consumption to some extent. And as I mentioned, there has been some front-loading of exports, and we also have the front-loading of this consumption of digital goods thanks to this consumer trading scheme. And property market, especially in top-tier cities, including Shanghai and Shenzhen, have been holding up relatively well. Yeah, so those are the main factors, encourage us to make this GDP upgrade. But however, we also mentioned in our report that China's economy is still likely to face strong growth downward pressures later this year. The U.S.-China tension is still, face quite big uncertainty. It may rapidly escalate once Trump shifts back his focus to China. And we may also see some payback of this consumer trading program and also export front-loading later this year. So we expect a sharp growth slowdown in the second half of this year to around 4% in Q4. And we maintain our 2026 GDP growth forecast also at 4%.
Okay, got it. That's very clear. So it sounds like still a tale of two halves for this year. Let's leave it there. Jing, thanks again for joining us.
Thank you.
That's it for now, and thank you again for joining us at Nomura Research and the Week Ahead, edited and produced by John Dalton. If you enjoy the content, please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or your usual provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can also check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.numeraconnex.com.